Hello everyone, today is Tuesday, November 4th, 2025. Hope everyone is doing well. Welcome to Tax and Accounting Ride Along, brought to you by Sands Virtual Enterprise, LLC. Your go-to dose of straight-talking tax and accounting insights for small businesses and the everyday taxpayer in the general public. With the year winding down, these insights couldn't come at a better time for making strategic business moves. So, without much further ado, let's crank it up and get into it.
Welcome back. We're doing a deep dive today into something really critical for a lot of people. Quarterly estimated tax payments. QETP. If you're managing freelance income, maybe substantial investments, or, running your own business, this is for you. We want to help you master these obligations.
Yeah, and avoid those nasty penalties. Smooth out the cash flow, too.
Exactly. So let's get right to the core trigger. You generally need to make these estimated payments if you think you'll owe, $1,000 or more.
That's the magic number. $1,000 or more in taxes for the year, after you account for any withholding you might already have, and refundable credits.
Okay, $1,000. And it's important to understand, right? This isn't some extra fee.
No, not at all. Think of QETP as just paying your annual income tax bill in installments throughout the year.
So why 4 payments? Why not just one big one at the end?
Well, the U.S. tax system works on a pay-as-you-go basis. The IRS wants you to pay tax as you earn the income. So these quarterly payments spread that liability out. For you listening, the real goal is managing your cash proactively.
Right, avoiding that huge, potentially crippling bill in April.
And the penalties. Don't forget the penalties and interest for underpaying.
Okay, so who's mainly on the hook here? We're talking self-employed folks, right?
Yeah.
Independent contractors.
Primarily, yes. And small business owners, basically anyone whose income doesn't have taxes automatically withheld by an employer. You carry the responsibility yourself.
Makes sense. Let's talk logistics then. The deadlines. They aren't exactly intuitive, are they? They don't line up with standard calendar quarters.
Huh? No, they don't. That definitely trips people up. You've got April 15th. Okay, that was normal. But then it's June 15th, September 15th, and the last one is actually January 15th of the following year.
June, not July. January, not December.
Got it. And missing one, or even just paying too little each time, that can trigger those penalties and interests almost immediately.
So it's not just about remembering the dates.
No, it's about the calculation. Paying enough each quarter is the real deep dive.
Which brings us to maybe the most practical part. How do you make sure you are paying enough? I think they call it the safe harbor rule.
Exactly. This is probably the most valuable nugget. The IRS gives you 2 main ways to avoid penalties, the safe harbors. First, you can pay at least 90% of the tax you expect to owe for the current year.
Okay, 90% of this year's tax, that requires some estimating.
It does, which is why the second option is often easier, especially early in the year. You can pay 100% of the total tax shown on your prior year's tax return.
Using last year's number as a baseline, that seems simpler.
It usually is. There's a small wrinkle, though. If your adjusted gross income, your AGI, was over $150,000 on that prior year return, you need to pay 110% of last year's tax, not just 100%.
Okay, 100% of prior year or 110% if income was higher. That seems like a solid strategy. But what if your income jumps around a lot during the year?
Yeah, that's a common problem. Maybe you land a huge project in Q3, or your business is really seasonal.
Right. If you just paid an equal chunk based on last year's total each quarter, a big income spike later could mean you haven't paid enough by year end, even if you met the 100% rule overall. You could still owe penalties for underpaying earlier quarters.
That's precisely where it gets more complex and strategic. If your income is uneven, the standard equal paying method might not work well. You might need to use what's called the annualized income method.
Annualized income. Okay, how does that work?
You essentially figure out your income and deductions for each specific payment period as it ends. So you calculate the tax owed based on that period's activity. You'd use Form 1040-ES. The worksheet there helps with this. It lets you pay less in slower quarters and more in high-income quarters.
So you match the payment more closely to when you actually earn the money.
Exactly.
Yeah.
It helps you avoid overpaying early on just to meet a safe harbor, but ensures you catch up when the income flows in, still meeting the overall requirements.
That definitely sounds more dynamic, but also maybe a bit more complicated to calculate correctly, especially with the safe harbor rules in mind.
It can be, which is why, honestly, working with a CPA or a qualified tax pro can be invaluable here.
How so?
Well, they can help you analyze last year's numbers, project this year's income even if it fluctuates, and figure out the best payment strategy, whether it's the simple prior year safe harbor or the more complex annualized method.
Making sure those 1040 ES payments are like perfectly tailored.
Right. Tailored to meet the rules, minimize penalties, and optimize your cash flow. It turns a compliance task into real financial strategy.
So wrapping this up for you, the listener, these quarterly estimated tax payments, they aren't just another annoying form to fill out.
No, they're really essential. Essential for avoiding those painful end-of-year tax surprises and, of course, the penalties.
They keep you current with the IRS.
And let you use those safe harbor rules smartly. It avoids headaches later.
So here's a final thought to leave you with. Think about this. What if engaging actively with these payments, maybe using that annualized income method if you need it, isn't just about tax compliance?
What if it becomes a tool?
Exactly. A tool for better financial management. But by mastering QETP, you essentially turn a required filing task into 4 built-in checkpoints for your budget and financial planning throughout the entire year. It forces that beneficial check-in.
Making tax planning part of your regular financial foresight? That's a powerful shift.
Well, folks, that's a wrap. Thanks for joining us for another episode of Tax and Accounting Ride-Along, courtesy of Sands Virtual Enterprise, LLC. Got feedback or curious questions? Or maybe a topic that needs some airtime? We'd love to hear from you. Connect with us at admin@sve-accountingandtaxes.com or text us at 4045-858513. Also, follow us on Facebook, Instagram, TikTok, YouTube, and LinkedIn for more insights. Catch you next time for more business talks and good times.